Aha, well done, you're still there. Thanks for sticking with us. We are moving on apace, and I've got none other than Chris Fleming, Head of Investments, Chief Investment Officer in essence, at Dynamic Planner, and the man who runs the team that pulled together the strategic asset allocation that sits behind those risk profiles. So I'm expecting a flurry of questions right now. Chris, you are in the process of looking at some changes to the strategic asset allocation. This is something that happens every now and then. Could you take us through the process of why you look at those long-term strategic asset allocations, what goes into building them, and then why, when changes are made, what's the reasoning behind it?
Okay. Well, there's a 5-step process to what we go through. So the first thing we do is every quarter we look at the capital market assumptions, and they're effectively our volatility, correlation or covariance matrix, and then expected returns. They feed into what is known as our unconstrained optimizer, which is a quantitative model which effectively looks to achieve the best level of return for a given level of volatility as measured by those risk statistics of variance and covariance. However, that is simply, if I would understate it for a second, a quantitative model. So it needs some governance process around it and a qualitative overview, which is where our investment committee comes in, where we look at the output and go, does that make sense based on where the current allocations are, where the assumptions are saying things should go, and given market conditions and some of the economic noise that's going on around us. So it has a governance process to effectively sign those allocations off. We change them every year because markets change every year. We're not trying to be tactical. We believe that's up to the fund manager and the people you had on before me to make those calls about what's going to happen in the nearer term. These are longer term strategic things. However, structural things happen in the market which mean that things need to change. I mean, Brexit was one last year. Low level of interest rates. Talks about unwinding quantitative easing. All those sorts of things need to play into the strategic allocation. If we were going to be tactical, we'd be doing it every quarter, but we only change the allocations once a year if we need to and re-centralise them back to the middle of the boundaries. Okay.
I was going to say, what's the where do you draw that distinction between a tactical decision and a strategic longer-term decision? And what are the you mentioned the 3 areas there of volatility and variance, covariance, correlation between the asset classes. What are the key things that you see? What sort of a shift would be required in order to make you think it's time to look at this?
Well, we're looking at it now. One of the things that's happening in the market is we've had suppressed equity volatility for a very, very long time. And we've seen this trail come down and down and down across all equity markets over a period of time. So that's maybe not that interesting on its own, but if you look at what's going on in the bond market and simply just look at UK gilts, and I've been doing this on our Academy shows over the last 3 weeks, you'll see that gilt market volatility has gone up and up and up, to the point where if you just look at it on a 3-year basis, and there's lots of different frameworks or time periods you can use, you're looking at about a 1 or 2% difference in the volatility now as they converge together. So what that means is effectively, if you're looking at the DT model, which is a relativity model in essence, where you're looking at increasing level of risks across broad asset class sets, you're seeing a compression or a convergence towards the middle. Now you have to say, is that the way things are going to go going forward? You have to take some views on that as a committee. So that doesn't necessarily mean it's a tactical view. It's still strategic in your thinking that can these conditions where the convergence can go, and will they ever cross over? And you need to take that in mind when you are framing the model and the allocations themselves.
Okay, so you're in that process at the moment. What's the outcome? You've got all your guys in a room. Come up with what's the conclusions?
Well, there's 2 broad themes. One is the volatility. That's an anomaly which has been going on in the market. We've seen that coming for a while. You've got low gilt yields. You've got other bonds which are also extremely low in terms of where the yields have been. An interesting one for us is global high yield. We introduced this into our asset allocation model 2 or 3 years ago because we realised that people were looking for higher yields from other asset classes. However, if you look at the spreads of those relative to a US Treasury spread, they've crossed over. Does that make sense? Does it make sense for you to have a global high yield bond from a Euro junk bond yielding less than, say, a US Treasury on a 10-year basis? It doesn't to us. So we think the reward in that particular asset class is not as attractive as what it once was. So we have removed that from the lower end allocations where we think it's an untoward level of risk for that particular part of the risk
So
profile.
where would that be? If you're sort of a risk profile 2, 3, 4?
So it featured in 2, 3, 4, 5
Right.
and 6 and maybe even 7 there was an element. So we've reduced it from 2 and 3 and 4. I'd actually removed it completely from that end and then tapered it off a little bit at those mid-levels when you want a little bit more of the risk in your portfolio. Another one is corporate bonds.
Mm-hmm.
So we've been looking to taper down the exposure to corporate bonds for a while. We don't like making massive changes because we realise there are a lot of people who use this. There are cost implications for trading and getting in and out of these things if you're following it religiously, which a number of people are. So corporate bonds we've been trying to taper down over a period of time because in collectivity, corporate bonds and global high yields are relatively illiquid relative to equities and have more equity-like downside in a bear market. And so we've been looking to downscale that. So we've reduced those particular allocations through those lower to mid levels and introduced cash for the first time at risk profiles 4, 5 and 6.
Right.
And the reason for that, and these are nominal changes, this is 4%. And it's because if we're going to take assets away from something, what's our alternative?
Yeah.
We can't
You
necessarily...
have to make it add up to 100% in the end.
That's dead right. We've got to put it somewhere, and gilt yields are low. We haven't adjusted them at all. We've just left gilts where they are. We thought we can't really add it into that. We can't really put it for the lower ones into equities because you're adding too much equity risk there, and equity markets are high relative to where they have been. So we've softened things with a little bit of cash in the portfolios. That doesn't necessarily mean just put it in a bank. You can still use cash funds in the market to get your exposure in that particular asset class.
Okay.
So that's one theme. Another theme is at the top end, we are reallocating things in a more geographical way. We've reduced emerging markets in Asia to the order of 2 or 3% in favour of the more developed markets. And the reason for that is simply not because we think the developed markets are more attractive. In fact, in the very long term, emerging markets has to be the most attractive offer. They've got demographics and everything in their favour.
We've been hearing a lot of that this morning.
I mean, it's you know, this is we're not trying to be tactical and say we don't think they're great by doing this. We are simply rebalancing into some more equity asset classes that we have within the model to make it more balanced across the board. And if you were to see the allocations in their entirety, you would see a more even split across those regional allocations. And we still maintain the UK home bias until we get really near the top end of things, which is an important component at the moment.
So again, there's the aim of doing all of this is ultimately to deliver the expected outcome that a client has agreed with their advisor. So there'll be advisors out there who are utilising that risk profiling process. Their clients come out as a 5 and they've agreed a strategy with their client to build around that. What are the takeaways for advisors in terms of what they need to do or consider when the asset allocation changes? Or is it in essence you're doing it in order that they don't have to do anything?
I think it depends on the advisor. There'll be advisors out there who want to select their own asset classes and their own funds, and they can still manage it. The underlying framework is exactly the same. We haven't changed the volatility boundaries, which was a debate we had in investment committee. You remember, like 3 years ago, we reduced them down because we could see the slide in volatility happening. We didn't change that. We felt it was an inappropriate time to look to do that. So all the underlying assumptions are all driving the same thing. If you were to take the allocation in the centre of the boundary as it is now, then that flows through to the value at risk figures, which are in Dynamic Planner, so the 5th, the 50th and the 95th percentile, and we expect it to be working within that range 90% of the time. And so that fundamental calculation has not changed. We're still thinking of the centre of the boundary, that drives the value of the risk numbers. And so that range would still operate the same. If an advisor wants to stick with the old ones, fine. Or if they disagree, or in one obvious area where you can have polar opinions on it is the use of UK property. Is it appropriate in your allocations? I mean, we debated this in the investment committee, and I've been saying when I've been around on our academy shows we had a hung parliament on it because half of us felt that it wasn't appropriate for advisor use, but the other half of us felt it does fit in a strategic allocation.
How do you resolve that then? How do you...
Oh, we put it to vote. We come on in favour of it. It's got a place in a strategic allocation. It has certain characteristics which are different from equities and different from the broad bond market. So therefore, it has got a place in a strategic allocation, if you think about it as simply as that. The thing with property is it's a very difficult thing to measure. All the returns series that you see are smoothed.
Yep.
So they make it look incredibly attractive. So if you run an optimizer, for example, it'll bung lots of it into property because it has all these great characteristics. But that's the job of the investment committee to say, we don't think putting that full amount of, say, 20% into property is an appropriate thing. But to go back to what we're talking about, we felt that it was appropriate to remain in a strategic allocation. When Brexit happened last year, a lot of you will know that funds gated for periods of up to 6 months. At that point in time, we did a webinar, discussed the implications and the reasons why the funds are gated, and they're all for very good reasons. However, if you're looking to run your client's portfolio and they need to get money out, then it has challenges. But within the model, you don't have to still use UK property if you don't want to. You can still allocate to something else. And at the time last year, we said, if you simply put the money into cash, you will not break your risk profile. You have the flexibility not to use property for the time being. So we've left it unchanged for the time being, but it'll be an ongoing debate of whether we reduce it to 5% or eliminate it completely. But for the time being, we think it's got a strategic place in a portfolio, long term.
Okay. So what's the, how often and what would create the need to update them again?
Well, we update them annually,
Yeah.
and really, I should have said this earlier, it's just a centralisation process. So the capital market assumptions drive everything. They drive a lot of things in Dynamic Planner. They drive the optimisation, they drive the value at risk numbers, and they drive the forecasting component of the tool. And so if those numbers become untoward and things start skewing away from the centralised position in the short term over the quarterly review when we look at things, then we may make an adjustment. However, we tend to like to hold it to an annual review just so people know it's coming. They can start budgeting for it and start thinking about possibly what could be happening here. So, if volatility continues to fall dramatically, and it's not falling dramatically because of the way we measure it, but it's incrementally building up, then we might have to look to add some more risk here and there. If it goes the other way, then we've got to be on our toes and maybe think about maybe we need to take some off. But you can generally last out a whole year. I mean, I've been with DT 5 years, and during that time we've never had to make a change on the basis of something that fundamentally has happened within the market.
Yeah.
Brexit last year, we had a big spike. Doesn't necessarily come through immediately in the numbers. Markets will do that from time to time. We can't be overreactive.
No.
If we are overreactive, then we'll create more problems and more churn and more costs for underlying clients.
Okay. You can find out more information about the capital markets assumptions to which Chris is referring to on the SimplyBiz Investment Services website under all the aspects of everything to do with Dynamic Planner, or talk to the team at SIS to find out more information. Chris, when do these changes come into effect?
So they go into Dynamic Planner on the 5th of October.
Right.
It's the first release date in the month.
Okay.
So they should be there, ready to go in a couple of weeks' time. Maybe even next week. I forgot what day of the week it is.
For those of you utilising a risk-managed investment solution, for example, the verbatim funds or model portfolios, those are designed to automatically update and maintain their alignment to those risk profiles, so that will happen. And obviously, it sounds like the volatility parameters aren't changing, so anything that's risk mapped or risk profiled over to those risk profiles, the change in the asset allocation really doesn't have any impact on those either, does it?
No, it shouldn't do. I mean, you can't make a completely broad sweeping statement and say the underlying assumptions won't have any effect on an allocation, because there's certain nuances and covariance and correlations, and all those things can make some mathematical differences, but they're pretty trivial. And so if you're following the allocation, then certainly you're going to stay within the boundary if you follow the allocation. If you use last year's allocation, you'll be in the middle as well. And for those managers out there who are following it and being tactical around it, then they've always had the flexibility to chop and change to make sure they stay within the overall risk profile 5, for example.
Great. Thank you very much, Chris.
Thank you, Dan.
I'm going to go out there and find Ken Davey, and we're going to come back in a few minutes' time, and we're going to look at the current landscape for the financial advisory businesses, what's happening out there in terms of regulation, in terms of pension legislation, and in terms of the day-to-day life of being a financial advisor. Stick with us and get those questions ready. See you in a moment. Thank you. you.